Welcome back to Investing Talk Podcast. Today, we are focusing on a company that's really right at the heart of this whole electrification wave, Navitas Semiconductor. We've pulled together the research, the numbers, the market chatter, basically everything we could find to tackle one big question for you. Is Navitas Semiconductor a good stock to buy right now?
Yeah, we've got quite a bit to unpack. We're looking at their core technology, what makes them special, their financial health, and critically, what might move the stock price in the near future. Think AI partnerships, EV developments, it's all in there.
And we really appreciate hearing from you. If there's a company you want us to analyze next time, definitely drop it in the comments below. And hey, if you find this discussion helpful, please give us a like and subscribe. It helps others find the analysis. Okay, let's get started. What's the foundational story here? Why is Navitas suddenly getting so much attention?
Well, first you need to grasp what they actually do. Navitas isn't just another chip company. They're leaders in next-generation power semiconductors, specifically gallium nitride GaN and silicon carbide, or C.
GaN and CC, why are those materials important? Why not just stick with traditional silicon?
Good question. It really boils down to performance limits. Silicon is great, but when you push really high power through it or switch it very fast, it generates a lot of heat, wastes energy. It's hitting a wall, basically. GaN and CC, though, they can handle much higher voltages, switch way faster, and they're incredibly efficient. Less energy lost as heat, smaller components needed.
Okay, so faster, smaller, more efficient. And that matters for...
Think about the big trends. Electric vehicles, people want more range, faster charging times, right?
Yeah.
GaN and CC help deliver that. And data centers powering AI. They consume enormous amounts of electricity. Making power conversion more efficient there is absolutely critical.
Yeah.
Navitas provides key components for enabling all of this.
So that focus, that specialization in GaN and CC, that's their competitive edge, their moat, so to speak.
Exactly. It's not just the materials, it's their integrated solutions, their patents around this tech. It creates a pretty significant barrier for the big traditional silicon players to just jump in and compete effectively overnight. It's a specialized high-performance play.
Makes sense. Okay, that's the tech angle. Let's pivot to the financials. High tech is great, but does a company have a solid footing? Especially in this high-growth, capital-intensive area.
Right. The numbers tell an interesting story. It's definitely a growth narrative. For 2024, revenues hit $83.3 million.
Okay, and how does that compare, growth-wise?
It's up 4.8% from the previous year, about $79.5 million.
Yeah.
So steady demand, continued growth. Not explosive year over year, but solid expansion.
But the big question for stocks like this, are they making money? Profitability?
Not yet. They're still in the investment phase, which is pretty typical for companies scaling up new technology like this. They reported a net loss.
How bad is the loss, and is it getting better or worse?
That's the key point. It's getting significantly better.
Yeah.
The net loss for 2024 was about $84.6 million. But that's actually a huge improvement, almost 42% better than the loss the year before.
Wow, a 42% improvement in loss reduction, that's substantial. What's driving that? Is it just cost cutting or is something else going on?
It seems like it's mostly about scaling and operational efficiency. As their production volumes increase, those initial heavy investments in R&D and manufacturing start to pay off. They're likely getting better leverage, better economies of scale. It suggests management is pretty focused on optimizing things as they grow. This points towards potential margin upside down the road.
Okay. Improving path towards profitability. Now, you mentioned something really striking when we prepped for this, their balance sheet, especially the debt situation.
Yeah, this is pretty remarkable for a company in this field. Navitas has zero long-term debt.
Zero. In semiconductors, that's unusual, right? Given how much capital they must need for R&D and facilities.
It's very unusual. It shows incredible financial discipline, no heavy interest payments weighing them down, maximum flexibility. It's a real strength.
So how are they funding operations then if they're not profitable and not taking on debt? Cash reserves.
Exactly. They have a strong cash position. As of the last report, Q2 2025, they had around $140 million in cash and equivalents. That gives them a solid resilience to fund their growth in R&D, even with negative free cash flow right now, without being forced to dilute shareholders immediately or take on costly debt.
Okay, strong foundation then. Zero debt, decent cash. Let's flip gears now to the market's view. The stock itself has been, well, quite active recently.
Oh, yeah, the price action has been dramatic. Really tells a story. If you look at, say, July through October this year, 2025, the stock just rocketed. It went from a low point for the year, around $1.52, all the way up past $10, hit $10.41. That's a massive rally.
A huge move. It's trading well above its key moving averages, the 50-day and 200-day, which confirms a strong uptrend, technically speaking. But after a run like that, isn't there a risk it's gotten ahead of itself? Is it overbought? Where's the support?
That's always the question after a big surge. We look at indicators like the RSI, the Relative Strength Index. Right now, it's in the high 60s.
High 60s. So strong momentum, but not quite in that overbought danger zone above 70 yet.
Precisely. It suggests there could still be room to run before the technical screen caution. It's strong, but maybe not exhausted.
So what are the key levels traders are watching right now for support and resistance?
The support level seems to be building nicely in the $8.50 to $9.50 zone. Holding above that would be bullish. The resistance, the immediate hurdle, is that recent high area, around $10 to $10.50.
Okay, so breaking convincingly above $10.50, maybe on good volume, that would signal the next leg up, potentially towards, what, $12?
That seems to be the consensus target range if it breaks out, yes. The near-term outlook looks like consolidation within that $8.50 to maybe $12 range, with a bullish bias.
Right. Now, who's doing the buying? Is this just momentum chasing, or is there real conviction behind this move? Institutional money? Insiders?
It looks like smart money is definitely involved. First off, Wall Street analysts are pretty positive. You've got a consensus buy rating from the 7 analysts covering it.
Okay, analysts are on board. What about the people who know the company best, the insiders?
That's where it gets really interesting. We've seen multiple Form 4 filings between August and October this year, showing the CEO and several directors buying shares on the open market with their own money.
Insider buying, that's usually a very strong bullish signal, isn't it?
It's one of the most reliable ones, yeah. And it's not just insiders. Institutional data, like from Whale Wisdom, confirms that major funds were accumulating shares in the third quarter as well.
So analysts, insiders, and institutions are all showing conviction. That paints a pretty compelling picture.
It does. They seem to be buying into the technology story, the improving financials, and the future potential.
Which brings us neatly to the catalysts. What's driving this optimism? What specific events or developments could push the stock higher from here?
It really comes down to Navitas positioning itself right in the sweet spot of these huge secular growth markets, AI and EVs.
Let's talk AI first. It's obviously the hot topic. How does a power chip company like Navitas play into the AI boom?
They're essentially helping to solve a major power problem for AI infrastructure. You hear about NVIDIA building these massive AI factories.
Yeah, incredibly power hungry.
Exactly. And they're moving toward higher voltage architectures like 800 volts DC to improve efficiency and reduce energy loss. Navitas has just launched new Gainian and Site components specifically designed for that 800-volt NVIDIA architecture.
Ah, so they're providing critical enabling technology for the next generation of AI hardware, making it more efficient.
Precisely. Their Gainians and Sector chips are much better suited for handling those high voltages and fast switching speeds than traditional silicon. They're positioning themselves as a key supplier for making these AI data centers actually feasible from a power and cooling perspective.
Okay, that's a powerful narrative. And there's an earnings report coming up soon, right?
Yes, huge near-term catalyst. Q3 2025 earnings are set for October 30th. Everyone will be watching that very closely.
What will investors be looking for in that report?
Clarity. Any confirmation of revenue contribution from this AI segment, any commentary on partnerships with data center players, maybe an updated outlook based on AI demand. It's a big one.
Makes sense. Now, AI is exciting, but EVs are still a massive market for them too, perhaps the core volume driver.
Absolutely. They haven't taken their eye off the ball there. We're expecting announcements later this month, late October, about new advanced GaN power ICs. These are specifically designed for making EV charging faster and more efficient. Reducing charging times, maybe improving battery longevity by managing heat better during charging.
And is there any buzz around potential big contracts in the EV space?
There's definitely some speculation, unconfirmed chatter, mind you, but persistent talk about Navitas being in discussions for a significant supply contract with a top-tier global EV maker.
Wow. Okay, if that gets confirmed, that would be massive. A game changer for their revenue trajectory.
Absolutely. Huge potential catalyst if it pans out.
So we have confirmed product launches, the critical earnings report, potential AI partnerships, and speculative EV contract rumors. What else is potentially in play? Any M&A talk?
Yes, that's another angle. Given their leadership in GaN and Ceresy and the importance of this tech, there's speculation Navitas could be a takeover target.
Makes sense. A larger, diversified semiconductor company wanting to quickly buy their way into GaNSiC leadership.
Exactly. It might be faster and cheaper for a big player to acquire Navitas than to try and build that expertise from scratch.
Yeah.
So M&A potential is definitely simmering in the background.
Any other product buzz?
There's also talk about another AI-optimized power IC coming soon, maybe for broader data center applications beyond just the NVIDIA architecture, and potentially a flagship design win with a major consumer electronics brand, perhaps landing early next year, 2026.
Okay, so the pipeline seems absolutely packed with potential catalysts, both near-term and medium-term.
It really does, which of course leads us to the crucial part, the risks. It's not all smooth sailing.
Right. Important reality check. The market seems to be pricing in a lot of success. What could go wrong? What are the key risks investors need to consider?
Well, the most obvious one is still profitability. They are improving, but they're still losing money. Execution is key. They absolutely have to deliver on that sales growth and translate it into positive earnings and cash flow. Any stumbles there could hit the stock hard.
So execution risk on the path to profitability. What else?
Customer concentration. Like many specialized suppliers, a large chunk of their revenue comes from just a few big customers.
The dependency risk. If one big client changes strategy or cuts orders.
Exactly. It could have an outsized negative impact on the results and shake investor confidence pretty quickly. They need to diversify that customer base over time.
And the technology itself. They have a lead now, but tech moves fast, right?
That's the constant threat in semiconductors. While they have a moat with GaN and Silicon now, big competitors are investing in these areas. Rapid innovation by competitors, or even a disruptive new power technology emerging, could eventually erode their advantage if Navitas doesn't keep innovating relentlessly. It's a perpetual race.
Okay, so profitability, execution, customer concentration, and the ever-present risk of technological disruption. Those are significant.
They are, but weighing those against the positives, the overall picture still looks quite compelling, according to the research we've seen.
How compelling? Is there like a rating or consensus view?
Yeah, analysts covering the stock assign it an average overall bullish rating of about 8.5 out of 10.
8.5 out of 10, that's quite high. What's driving that strong rating, summarizing the bull case?
It's really the convergence of factors. You've got the fundamentals, improving accelerating revenue, better margins, that zero debt balance sheet. Then you have the market signals, the bullish technicals, the insider buying, the institutional accumulation.
And layered on top of that is this rich pipeline of near-term catalysts we just discussed: earnings, AI, EV developments, M&A buzz.
Exactly. It's that combination. Solidifying foundation, positive market sentiment, and a packed schedule of potential positive news flow.
So bringing it all together for the listener who's considering this stock now, what's the bottom line? How should they think about the opportunity?
Well, it looks interesting on two levels, really. It could be viewed as a short-term trading opportunity, trying to capture upside from these upcoming catalysts, particularly the earnings report at the end of October. But it also appears to have legs as a long-term investment play on the fundamental shifts towards electrification and more efficient power management, driven by GaN and Silicon technology.
So potentially appealing for different strategies and time horizons, depending on your risk tolerance.
Precisely. The narrative seems strong enough to support both approaches, though obviously with different risk-reward profiles.
Okay, that's a really thorough analysis of Navitas Semiconductor. We covered the unique tech, the zero debt strength, its key role in AI and EVs, and those upcoming catalysts.
Yeah, it definitely seems like a company positioned right at the intersection of some very powerful long-term trends. Its success looks closely tied to this global push for better power efficiency.
All right, so for you, the listener, something to chew on after this discussion. We talked about Navitas having zero debt, which is rare. We also know AI-related companies are getting huge valuations right now. So here's a thought. Could a company like Navitas, potentially an attractive acquisition target, instead use its strong position and market hype to do a large secondary stock offering, raise a ton of cash without debt, supercharge their growth independently, and maybe signal they don't want to be acquired? What would that mean for investors? Something to think about. Thank you so much for joining us for this analysis today. We hope this gave you the insights you need to feel well-informed about Navitas Semiconductor.